Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. And here we are with the Fed watch. Remember that old football cheer? Push it back, way back. Well, that's what we're getting. Once again, the Fed kept rates unchanged at the May FOMC meeting. So as a result, Fed funds trading range remains in the 5.25% to 5.5% band that was introduced in July of last year, and still resides at a more than 20-year high watermark. And for those of you keeping track, this represents the sixth consecutive FOMC meeting where the policymakers decided to take no action on the rate front. Despite the economic and inflation data that continue to challenge rate cut expectations, Powell and company still seem to be on the page that a rate cut will more than likely occur sometime later this year. However, what investors are finding out is that this potential easing move keeps getting pushed back, and increasing uncertainty has now entered into the equation as to what this potential rate cutting episode could eventually look like. Now, the Fed, what was widely expected, they did it yet again, and keeping the Fed funds target unchanged, you have to acknowledge that these are relatively new expectations. The monetary policy outlook here in the U.S. has been turned on its head thus far in 2024. I mean, just a few short months ago, the money and bond markets were looking for 6 rate cuts this year. That as I'm talking to you now, the implied probability for Fed funds futures is priced for less than 2 rate cuts, at least heading into the results of the meeting. So it's truly amazing to see how rate cut expectations went from double the Fed's dot plot to now being actually less than the 3 moves the Fed is forecasting. And in addition to that, the initial easing move has gone from March to June and now maybe September. So against this backdrop, investors are left trying with, determining or ascertaining what exactly Powell and company will do at the remaining 5 Fed meetings this year. Think about that. We're already 3 out of 8 done. It's flying by, isn't it? So obviously, the policymakers' data dependence remains on full display, and certainly the labor market and inflation data have not only provided the Fed with no urgency to considering easing monetary policy anytime soon, but it's calling into question whether any rate cuts are going to be needed at all. And as a result, the voting members apparently feel right now they can just sit back and be patient. But looking ahead, though, don't you get the sense sometimes that Chairman Powell seems to be itching to cut rates, but the data needs to lead him there? And what does that mean exactly? Well, in my opinion, renewed progress on inflation is a necessary ingredient in the process. That's something that they mentioned in their policy statement, that there has been a lack of further progress there. So that's certainly front and center. And of course, some softening in labor market conditions would also help the Fed chairman get there. And let's not forget QT, quantitative tightening. The Fed is not cutting rate yet, but their balance sheet plans are coming into focus now. An imminent end to QT doesn't appear to be on the horizon or on the table, but reducing the pace of their balance sheet runoff will now become part of the monetary policy landscape in 2024, as it announced that they will begin tapering QT in June. So what should investors be looking for going forward in terms of monetary policy? Well, if history's any guide, the Fed's not just going to begin cutting rates with any guidance on that front. At this point in time, I start with the Fed's dot plot. I go from there and say probably less than the 3 cuts seems to be the reasonable case scenario, but stay tuned. As we've been finding out, things change rather quickly. So I'm going to end it there. Hope you all have a great rest of the week and be well.